Hello everyone. In this video, I will discuss M&M Proposition II. In the last two videos, you have seen the M&M Proposition 1, where M&M argues that capital structure doesn't have any impact on share price. So investors are essentially indifferent between the proportion of debt and equity used in the capital structure of a firm. Now, what does M&M Proposition 2 is? Look at this equation: return on equity equals to return on asset into plus the return on asset minus debt, the cost of debt, into the debt ratio, debt by equity. Now, what M&M Proposition 2 argues that expected return on a common stock, which is the expected return on equity, is indicated here. Common stock of a levered firm increases in the proportion of debt to equity ratio. Okay, and the increase in return on equity based on debt to equity ratio depends on the spread between return on asset and cost of debt. Okay, so you can see that as long as this difference is positive, higher debt equity ratio will result in higher return on equity. Okay, let me summarize. Return on equity depends on debt to equity ratio, that means the proportion of debt you use, and the spread between return on asset and cost of debt. Now, if a company uses more and more debt, so it has a higher debt to equity ratio, and the company earns a return which is higher than the cost of debt, then higher debt will result in higher equity. That's what the M&M Proposition 2 is. Now, as I already indicated, that M&M Proposition 1 says that financial leverage has no effect on shareholders' wealth. However, in Proposition 2 is saying that return on equity that you can expect to receive on shares increases as the firm uses more debt, right? So how can shareholders be indifferent to increase leverage when it increases expected return? The answer is that any increase in expected return is exactly offset by an increase in risk. Therefore, shareholders' required rate of return. Okay, so look at this example where, first of all, a company is all equity firm, so its return on asset and return on equity is the same. So expected operating income divided by market value of all securities, so its return on equity or return on asset is the same, which is 15%. Now company goes for 50% debt and 50% equity. So it has 5,000 debt and 5,000 equity. Return on asset is 15% and cost of debt is 10%. So what does it mean is the company is earning 15% return and its cost of debt is 10%. So its return on equity is 20%. So you can see that previously when the company was all equity firm, its return on equity was 15%, but when company uses debt, as it's using debt and its return on asset is greater than cost of debt, its return on equity increases to 20%. So that's what M&M Proposition 2 is, that return on equity increases as company uses more debt. However, then how investors can be indifferent between these two? Here return on equity is 15% and return on equity is 20%. Investors cannot be indifferent. Investors must prefer this higher return on equity. It means that investor must prefer higher debt. So if a company uses higher debt, that should have a positive impact on the share price. However, what M&M argues that although higher debt increases return, this increase in return is exactly offset by the investor's required rate of return due to increase in riskiness. Because you understand, as the company uses more debt, its riskiness goes up, so investors' required rate of return also goes up. As a result, although the return on equity increases, it's exactly offset by the additional required rate of return due to additional risk. That's why investors will be indifferent between the increase in return, because that's increase in return is simply a compensation for additional risk. Now look at this example. When company is all equity firm, its earning per share is 1.5 when operating income is 1,500, and earning per share is 0.5 when operating income is 500. So change in earning per share is $1 and return on share is 15% and 5% respectively, so its difference is 10%. However, if company goes a combination of debt and equity, earning per share is 2 when operating income is 1,500 and earning per share is 0 when income is 500. So change is -2, and return on shares is 20% and 0%. So change is -20%. So you can say that when company is using all equity and operating income declines from 1,500 to 500, still company has a positive earning per share and company has a positive return on share. However, when company goes for 50% debt, when operating income declines from 1,500 to 500, the company's earning per share and return on share declines to 0. It means that when company goes for additional debt or company goes for using debt, company takes more risk. As a result, investors will require a higher return, and investors' required rate of return, increase in required rate of return will offset the additional return on equity. As a result, investors tend to be indifferent. Now, let us revisit this example where a company has an value of asset is 100 and company has 30% debt, 70% equity, and firm value is 100. So its cost of debt is 7.5% and return on equity is 15%. So you can see that cost of debt is 7.5% and return on equity is 15%. So this is the proportion of debt and this is the proportion of equity. So return on asset, I mean the return on overall package, overall capital is 15.75%. Okay, so that's the weighted average cost of capital. Now, if the firm is contemplating investment in a project that has the same risk as the firm's existing business, the opportunity cost of capital for the project is the same as the firm's cost of capital. That is 12.75%. What would happen if the firm issued an additional 10 of debt and used the cash to repurchase 10 of equity? As a result, it comes to here. So previously equity was 70, now equity is reduced to 60 because $10 equity is repurchased back by issuing $40 of debt. Okay? Now, the change in the financial structure does not necessarily affect the amount of risk of the cash flows on the total package of debt and equity. Therefore, if investor required a return of 12.75% on the total package before the refinancing, they must require a 12.75% return on the firms afterward as well. So although the required return on the package of debt and equity is unaffected, the change in financial structure does affect the required rate of return on individual securities. Since the company has more debt than before, the debt holders are likely to demand a higher interest rate. So previously it was 7.5%, now it increased to 7.875%. Okay, as a result, you can see that cost of equity now is 16%. So increasing amount of debt increases debt holders risk that led to a rise in the return on debt holders required. That is 7.87%. The higher leverage also made the equity riskier and increased the return that shareholders required, which is 16% from 15%. Okay, although the weighted average cost of capital remains the same, 12.75%. We have looked at how the changes in financial structure affect expected return. Let us now look at the effect on beta. The stockholders and debt holders both receive a share of the firm's cash flow and both bear part of the risk. For example, if the firm's assets turn out to be worthless, there will be no cash to pay stockholders or debt holders. But debt holders usually bear much less risk than stockholders. Debt betas of large firms are typically in the range of 0.1 to 0.3. If you owned a portfolio of all the firm's securities, you wouldn't share the cash flows with anyone. You wouldn't share the risk with anyone either. You would bear them all. Thus, the firm's asset beta is equal to the beta of the portfolio of all the firm's debt and all the firm's equity. The beta of this hypothetical portfolio is just weighted average of debt and equity beta. So beta will be the weighted average of debt and weighted average of equity. So you see that beta of equity will be the beta of asset plus debt, and the difference between beta of asset and beta of debt. It's similarly this equation, right? And this is how we calculate weighted average cost of capital. We are familiar with this equation. So weighted average cost of capital is essentially the return on asset, which is the cost of debt, cost of equity, the proportion of debt, and proportion of equity. This is M&M Proposition II. The expected return on equity, you can see it is this line. Expected return on equity increases linearly. You can see linearly with the debt and equity ratio, so as long debt is risk-free. Okay, when it is risk-free, it increases linearly. But if leverage increases the risk of debt, for example, when it goes up, it increases risk of debt. Both the debt holders and equity holders want a higher return. As a result, you can see that return on equity increases, but increases at a slower rate. Okay, slower rate, since now that will be offset by the additional risk. Now this is a comparison of the traditional view and the MM view. You can see that this solid line shows the traditional views and this dashed line shows the MM view. The traditionalists say that borrowing at first increases the return on equity more slowly than MM predict, but that return on equity shoots up with excessive borrowing. If so, the weighted average cost of capital can be minimized if you use just the right amount of debt. However, you can see that MM argues that return on equity increases as the firm uses more and more debt, because investors, risk-averse investors, will want more return for borrowing more money even if they are the equity holders. So this is the weighted average cost of capital formula we are already familiar with. Now, if there is a tax advantage, you know that since interest is paid before paying the tax, due to interest payment, we get a tax advantage, and which is incorporated as 1 minus tax rate. Okay, so this part is basically the after-tax cost of debt. Previously, this is the cost of debt part, and we didn't incorporate taxes, but since we get a tax advantage, now we incorporate tax. So this is the after-tax cost of debt, this is cost of equity, and the combination is weighted average cost of capital. Let's see a couple of examples. The firm has a marginal tax rate of 35%, the cost of equity is 9.8%, and the pre-tax cost of debt is 4.2%. Given the 9.4% debt ratio, what is the tax adjusted weighted average cost of capital? So debt ratio is 9.4%. As it was mentioned that 9.4% is the debt ratio. Since debt ratio is 9.4%, equity ratio is 90.6%. Okay, so this is the weighted average cost of capital formula we use. So a debt ratio is 9.4% and equity is 90.6%. This part is the cost of equity and this part is the cost of debt. So this is the proportion of equity and this is the proportion, this is the cost of equity, this is the proportion of debt and this is the cost of debt, and this part is the 1 minus 0.35, so which is the tax portion. So in total, this is the after-tax cost of debt, and which is 9.1%. Now, Kate's Cafe has a marginal tax rate of 35%, the cost of equity is 10%, and the pre-tax cost of debt is 5.5%. Given the book and market value balance sheet, what is the tax adjusted weighted average cost of capital? So these are the market values, and as usual, we calculate debt ratio and equity ratio, and this is the weighted average cost of capital, the very similar formula that we have seen previously. So that's the end of our discussion on M&M Proposition II, and also that ends our discussion on Chapter 17. So please don't hesitate to let me know if you have any issue understanding any of the topics. Thank you very much.